What is a kangaroo market? Trading strategies explained. A kangaroo market refers to a stock market that moves sideways with unpredictable ups and downs. It doesn't follow a clear upward, bull or downward, bear trend. Instead, prices jump like a kangaroo, without strong direction. This type of market can last for months or even years, often appearing after high volatility events like global economic uncertainty or policy shifts. It creates a tough environment for long-term investors who rely on clear trends. But it also opens up short-term opportunities for traders who adapt quickly. What makes this market tricky is the inconsistency. Stocks may rally for a few days, only to drop suddenly. Market sentiment shifts quickly based on news, interest rates, or earnings reports. It's not rare, either. Recent global events, from pandemics to geopolitical tensions, have led to more choppy, sideways markets, especially in major indices like the S&P 500. Understanding the kangaroo market is key to building flexible strategies. It forces investors to think differently. Instead of buy and hold, they might shift to short-term plays, hedging, or higher cash reserves. It's actually a pretty clever metaphor. Just like kangaroos hop around in a non-linear, erratic way, the market in these phases behaves unpredictably. There's no clear trend. It's like trying to read a weather forecast where sunny, rainy, and cloudy days all happen within 24 hours. Understanding market types. Bull market. Stocks are climbing, optimism is high, and investors are buying in. Bull markets are usually tied to economic growth, strong earnings, and investor confidence. Bear market. The opposite of bullish. Prices are falling, fear is in the air, and everyone's talking about recession. Bear markets can be brutal, but they're a normal part of the cycle. Sideways market. The market is neither up nor down, just a lot of churning in the same price range. These markets can be boring for long-term investors, but interesting for short-term traders. Now imagine all three mashed into one. A kangaroo market isn't steadily going up, down, or staying flat. It's bouncing all over the place, creating an environment of volatility without direction. While bulls and bears give direction, kangaroo markets provide confusion. They demand more nimble strategies. Long positions require tight stops. Shorting can work, but only briefly. Fundamental analysis offers less predictive power, and technical setups often fail. In short, it's not a place for lazy investing. It rewards quick thinking and risk control. These markets emerge from conflicting economic data. Rising inflation, mixed earnings, and geopolitical tensions can all fuel market confusion. Investors react emotionally, causing erratic swings. Another reason is shifting monetary policies. Central banks adjusting interest rates can stir volatility. When traders don't know what to expect, prices jump around with no pattern. Several other factors can lead to a kangaroo market, such as economic uncertainty. When economic indicators send mixed signals, the market doesn't know whether to celebrate or panic. Geopolitical tensions, war, elections, trade disputes. Any of these can shake investor confidence and drive erratic moves. Investor sentiment swings. Fear and greed tugging in different directions can make the market flip-flop daily. Interest rates and central banks. Confusion over rate hikes or easing policies can cause unpredictable spikes and dips. When investors can't agree on the outlook, the market doesn't commit to a direction, and that's when the kangaroo starts hopping. Success in a kangaroo market depends on flexibility and discipline. Traders must respond quickly to market changes and avoid overcommitting, because it affects how your investments perform, how safe you feel putting money in the market, and even how your retirement savings grow. Understanding it can help you avoid panicking and making poor financial decisions during volatile times. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use the code BLOG to receive 25% off your next purchase. The impacts on investors and traders of kangaroo markets are: emotional toll and decision paralysis. Watching your portfolio bounce up and down like a ping pong ball. Stress levels equals maxed out. Volatility is a double-edged sword. Volatility means more risk, but also more opportunity. If you know how to manage it, you can profit even in chaos. Opportunity for skilled traders. Swing traders, day traders, and scalpers can thrive in a kangaroo market if they're sharp and disciplined. Some of the popular strategies to trading in a kangaroo market includes: focus on short-term gains. Long-term investing can be risky in a kangaroo market. Short-term trades are safer. Look for small profit opportunities. Scalping or day trading can help limit exposure to sudden swings. Use technical indicators wisely. Rely on tools like Bollinger Bands, Relative Strength Index, and Moving Average Convergence-Divergence technical indicators. These indicators highlight overbought or oversold conditions. Combine them with volume analysis to improve accuracy. Set tight stop-loss orders. Risk management is crucial. Always set stop-loss orders to protect your capital. Keep them tight to avoid large losses during sudden market moves. Trade the ranges. Kangaroo markets often move sideways. Identify support and resistance levels. Buy near support, sell near resistance. This strategy works best when price moves stay within a known zone. Stay agile and informed. Adaptability wins. Watch economic news, earnings reports, and central bank updates. Use them to guide your trades. Flexibility is a key edge in uncertain markets. Limit exposure and diversify. Don't put all your money into one trade. Spread your investments across different sectors or asset classes. Diversification reduces risk when markets behave erratically. Don't ignore fundamentals. While technicals dominate, ignoring earnings reports or macro trends can still burn you. Hedging against losses. Use options, inverse exchange traded funds, or safe haven assets, like gold, to protect against downside risk. Stay liquid and limit exposure. Cash as a position. In a kangaroo market, that mindset can save your portfolio. Keep more capital in cash or short-term instruments. Trade smaller position sizes. Use tighter stop losses to control drawdown. Liquidity gives you the flexibility to act. If you're over-leveraged or stuck in bad trades, you lose that edge. Smaller trades mean you're not emotionally attached. You can enter and exit with less friction, ideal for choppy markets. Here are pros and cons of trading in a kangaroo market. Some of the pros are: opportunities for quick profits, more setups for active traders, increased volatility boosts intraday ranges. Some of the cons are: harder for long-term investing, higher false signals, emotional fatigue from constant decision-making. The biggest advantage? If you're disciplined, you can outperform passive investors. But it requires consistent effort. The downside? Many traders get chopped up chasing breakouts or holding losing trades too long. Success comes from managing risk, not maximizing return. Aim for high win probability, not high returns per trade. Conclusion: a kangaroo market can test the patience and discipline of even the most seasoned traders. But with the right strategy, ranging from technical setups and volatility tools to risk control and psychological discipline, it is possible not just to survive, but thrive. Rather than trying to force trades in an unclear market environment, smart traders adapt their strategies, stay vigilant, and maintain flexibility. Whether you're a day trader, swing trader, or long-term investor, recognizing kangaroo market conditions and adjusting accordingly is key to sustainable success. Thank you for your support and thanks for watching.